Good morning or good afternoon, and welcome to our webinar, Developing and Articulating Your Bank's Risk Appetite Statements, and Key Risk Indicators. My name is Jeff Rigsby. I'm the President and CEO of CB Resource, and I will be presenting today's session. First, I would like to thank you all for taking time out of your busy schedule to join us. In our invitation, we said the session will run about 30 minutes, and I certainly intend to keep to that schedule. So just before we do get started, just to a little bit from getting the most out of the session or getting the most out of the webinar, should you have any questions during the course of the session, by all means, there is an instant messaging module there in GoToWebinar, and you can certainly post a question in real time. We'll also have a brief question and answer period at the conclusion of the presentation. And just so you know, to the extent you're interested in getting our presentation materials, by all means, shoot us an email, give us a call, or even send us a message via GoToWebinar, and we'll certainly get you a copy of this. We'll also be recording it, and for those of you that are members in CB Bank Analytics, it will be available in the Help Center in our portal. So let's get started. The purpose of today's webinar is to provide a brief overview and to some extent maybe a how-to approach to help you develop your bank's risk appetite heat map, your risk appetite statements, and assist in creating key risk indicators that can be tracked and really let you know how you're performing within your heat map or your risk appetite framework, if you will. What we're going to do as far as the course or our process today, a brief definition on risk appetite. I do want to spend a moment on where risk appetite falls in the ARM process. It's an important factor. Then we're going to go ahead and walk through the 4 steps that will assist or help you develop your risk appetite and the related materials. Some closing comments on how it all comes together, and then some of my closing thoughts as it relates to risk appetite, risk profile, and things of that matter. And then we'll get to our Q&A section. So let's go ahead and get started. Risk appetite. So what is risk appetite? Risk appetite is the level of risk that your bank is prepared to accept to achieve your financial and strategic goals and objectives. Pretty straightforward, right? Your risk appetite actually should reflect or be a clear reflection of your strategic intent, your strategic direction. And said more simply, your risk appetite should basically articulate what you're willing to do or not do to make money and create value. It's really your way of quantifying the level of risk you're willing to take or not take in pursuit of optimizing value. Okay? And you can see just by this illustration here, this is an example of just one way you can articulate your risk appetite using a 5-point scale in key risk categories. And we'll get into that in just a second. So the reason I wanted to touch just briefly on an ERM model is risk appetite is essential to an ERM process. And so if you're currently implementing an ERM process and you haven't taken the time to quantify or articulate your risk appetite, I think it's a disservice to the process. And now we happen to be advocates of a top-down approach, but the reason we want to put risk appetite out at the tip of the spear of an ERM process is it tends to determine where the level of risk you're willing to take resides, right? And so if you're taking a significant amount of risk in one way or another, to know that up front actually helps you right size or calibrate your ERM system, right? So, and if you think about every non-negotiable or every ERM system of non-negotiables is how you identify, measure, monitor, and control your risk. And by bolting that risk appetite on the front end, it should help you refine or actually calibrate your enterprise risk management process, right? So if you're doing cryptocurrency, or if you're got a ton of MSBs and you have elevated exposure to AML and BSA type issues, by all means, your enterprise risk management system should reflect where your risk resides and ensure it's adequate to make sure you're assessing, measuring, monitoring, and controlling risks in those areas. So that's the only comment I wanted to make and why I kind of put that in the process. It is important to understand what your risk appetite is as it relates to ERM. Now, before we review the process, it is important to emphasize a practical approach to getting the job done. So your goal is to develop your risk appetite statements, and your key risk indicators. And as strange as it may sound, it's nice to have a checklist of, what's my process map to get this done. So I just want to touch on that for just a minute. So when you think about it, who are the people that should be involved in this process? Well, the thing about risk appetite is so tightly connected to your strategy. This isn't one of those bottoms-up kind of exercises. This is a top-down exercise. Now, whether or not you involve your board in the process, they ultimately should be involved in signing off on it just like they would sign off on your strategy. But minimally, when you select your team to be part of this process, it should be your senior executives, and then maybe some additional support staff that are involved in implementing your strategy. But it should definitely be the senior team. Because there is a little bit of heavy lifting involved in this process, you should kind of put together a timeline. Like, how much time is it going to take? When do we need to meet? Do we need somebody to help facilitate the process? But establish a schedule, right? Because this isn't something you can sit down in 30 minutes or 45 minutes and get done. It does take a little bit of heavy lifting. With that said, make sure you've got the right information at your disposal in order to make the time well spent. So minimally, you've got to have your strategic plan in front of you, because your strategic plan pretty much says what level of risk you intend to take or are taking in the business you do. So you want to have your strategic plan. Maybe you have some comparative analysis, maybe some additional data, but minimally your strategic plan is necessary in order to quantify the level of risk you're willing to take in these different areas, right? Go ahead and initiate the process. Do whatever it takes. It might be a series of meetings. Maybe it's one long meeting. Maybe it's linked to your strategic planning sessions, or however you approach strategy. Point is, go through the process, develop the statements, develop your heat map, develop your statements, develop your KRIs, and at some point in time, package them in such a way to present to the board. And that's kind of the process we would certainly support and share with you. So now that we've done that, let's go ahead. Here are the 4 steps to develop and articulate your risk appetite and do the additional items we mentioned. And I'm going to take the balance of our time together to walk through each of these steps. So just if you think about it, the first step is just understanding your strategic value drivers. And this exercise is really nothing more than spending that time looking at your strategic plan, if you will, and drawing out where the risk is. How much growth is in that plan? What types of products are in that plan? So we'll get into that more, but understanding your strategy and where your strategy is taking you and where your business model is taking you is the basis to start converting that to step 2, which is articulating that in some form of risk appetite framework, right? So the ones we show are kind of a heat map that says, we're willing to take X amount of risk here, not so much risk there, and so forth. So you understand the strategic value drivers, you convert them into levels of risk you're willing to take by risk definition, and then moving into how do we develop those statements. And then step 4 is, so how do we take those first 2 elements and develop this list of key performance indicators or key risk indicators and key risk ranges, if you will, so we can figure out and plot where we reside within our risk appetite. So let's look at step 1. Step 1, your strategic goals or value drivers are central to determining your risk appetite, right? So if you really think about it, opening up your plan, whether you have a heat map in there or a risk appetite statement in there or not, it is implicitly or explicitly defining what level of risk you're willing to take. And just ask yourself, it's kind of a series of rhetorical questions, how much are you looking to grow? Growth is a key factor to the level of risk you're willing to take. Is it a modest level of growth, moderate level of growth, average level of growth, above average level of growth, aggressive level of growth, quantum growth? So growth is a key factor, right? That's a key strategic consideration when you evaluate the level of risk you're willing to take. What types of earnings? Do you want well above average earnings? Are you looking to optimize your non-interest income and getting involved in business lines that would contribute to that? Are there characteristics to your products that reflect a modest level of risk or a significant level of risk? I've got a bank down the road from me that is now a platform for cryptocurrency transactions. That's a strategic decision they made. I think there's some risk in that. Where does that reside? How do you track it and control it? So understanding where your strategy is taking you is kind of key to approach a way to articulate where your risk resides or what your risk appetite is. So those are kind of some fun facts about that, right? So when you think about it, your risk appetite is not static. It doesn't change day in and day out, but it should be tied to your strategic planning process. Things can happen that can influence what you're willing to do or not do to make money. A certain surge in the marketplace could actually open up opportunities, and you may take a little more risk because a condition occurred, but there could be reasons to pull back. We're kind of on the long end of economic recovery, right? We're kind of at the tip of the cycle right now. And is this a time we might want to look at economic considerations and say, gosh, are we approaching a slowdown? Should we adjust our risk appetite, which would suggest we're going to adjust or maybe pull back in certain areas? Any number of factors. I just want to make the point that as you develop your risk appetite, it's not a static exercise. It's dynamic, and it does evolve with the evolution of your strategic plan. Okay, so step one is really articulating kind of those strategic hot buttons, right? Really, where does it reside? Now, when we move into step two is really more about, and actually, by the way, I broke down step two into three sections so I can address it appropriately. So number one, I want to talk about your framework. How do you select a framework? Number two, I want to talk about, so what do you consider? So when I'm mapping my risk appetite, what factors do I need to consider to determine if my risk appetite is low to high? And then third, how do I plot those considerations into a meaningful way to articulate, my risk appetite? So the first thing we want to talk about, though, in this step is, what is the lens in which you choose to see risk? Now, what you're looking at right now is one that we might use commonly, and we're showing key risk categories, right? Credit risk, interest rate risk, liquidity risk, operational risk, compliance, strategic, reputation, cyber. You could include business groups like mortgage and insurance and wealth management and trust. If you have a payment system, if you have some other non-traditional line of business. But choosing categories, you could use CAMELS. I've seen people use CAMELS. You could use OCC's got a very clearly articulated framework of 8 key risks, and it ties back to your regulatory exam. You can use their framework. FRB has a modified version of that. But I guess the point I'm making here is adopt a lens, or if you will, or a framework that makes sense to you. If you happen to be an OCC bank and you said, hey, we may as well use the OCC framework because it'll facilitate our communication with our regulators. And oh, by the way, they tell you what your risk profile looks like by those factors. So my point is adopting a framework that's relevant or makes sense to you. There is no right or wrong framework as long as you're looking at where risk resides and then some sort of scaling, right? In this case, we use a 5-point scale, 1 being low and 5 being high, and plotting it somewhere in between. But the first step in the process is you're developing your heat map or your framework is choosing a framework, right? And that gets you going. Now, once you've selected your framework, it's really in evaluating you move to evaluating key considerations, right? So the goal is to understand your bank's planned risk-taking characteristics under major categories. And so if you think about it, and by the way, if you guys want a copy of this list, shoot me a note, whatever, and we'll get you a copy of this. But it's kind of like a user's guide to say, so what types of questions do I need to ask myself when I'm plotting my risk appetite by risk category? Right, so let's just briefly kind of touch on this for a bit. So let's talk about credit. Obviously, growth is a factor, right? How much do I intend to grow? And again, as I mentioned earlier, is it a modest level of growth? Is it a quantum level of growth? Is it somewhere in between? Growth is a factor that drives or is in your risk appetite influences your growth, or growth is a direct reflection on your risk appetite, right? What's your product mix? What types of products are you offering, and what are the characteristics embedded in those products that determine a certain level of risk? And how do you support the process of marketing, selling those loans? What does your channel system look like? Do you have loan brokers? Do you have BDOs? Do you have relationship managers? Do you have a branch network? Do you have a web-based platform that's regional? Are you a regional SBA shop? And if you're a regional SBA shop, do you run CRE concentrations between 600 to 800%? And what does that say about your risk appetite? I've got ag lenders that are heavily concentrated in dairy and poultry. what does that say about your risk appetite? Right? All those I've got banks that do cross-border lending. What does that say about your risk appetite? How far are you up against your legal lending limits? What does that say about your risk appetite? Right? So it's kind of quantifying the level of risk you're willing to take, right? Be it growth, be it product mix, be it type of customer, be it the role of technology, alternative platforms, concentrations, all those factors articulate what level of risk we're willing to take or not take in a given area. Interest rate risk could be low risk and you just focus on good core deposits, it's yields and costs, right? What I make on my earning assets, and 80% in lending and 20% in securities, and I leverage modest instruments and I keep it pretty close to the vest, or am I leveraging some exotic instruments to hedge or to better preserve a long-standing good spread or strong yield? So asking those questions around interest rate risk. Liquidity, pretty straightforward, right? If you're using this as a framework, if you're using key risk categories as a framework, liquidity is pretty easy. If you're running a loan-to-deposit ratio between 95 and 105, you have more than an average level of risk appetite. I would say you're more than moderate, right? If you have a strong dependence on non-core funding to support your loan growth, you may be above moderate, right? If 10% of your deposits are broker deposits, you may be above moderate. But it's those questions that need to be asked, right? And operational risk, think about it. Is M&A a central part of your strategy? Do you aggressively or opportunistically pursue mergers and acquisitions? And what does that say about your risk appetite? Say from an operational standpoint, you have to integrate systems, you have to integrate people, you have to integrate products, you have to integrate customers. What's that say about your risk appetite? Are you leveraging technology as a delivery system? Are you starting to automate loan approval processes and access to credit through the web? Are you partnering with more third-party independent providers to be more competitive or to grow your business? All of these considerations influence what level of risk we're saying we're willing to take, right? Compliance, pretty straightforward. If you're in a consumer-sensitive business, if you are in mortgage, if you are in insurance, if you're in wealth management, if you're in trust, dealing with individuals, consumers, there are issues with consumer protection laws and fair lending that suggest you might be willing to take on a little additional risk in compliance. If you have a bunch of MSBs as customers, my guess is you're taking on some additional AML, BSA risk. And so does that find a home in your risk appetite? And is it articulated in your risk appetite? But these are the types of factors, right? And just to wrap it up in some of these key areas, from a strategic standpoint, you might be looking at adding multiple non-interest income type business lines. The traditional ones that could be like, insurance and wealth management, or maybe you have a payment system or platform. Like I mentioned, I got a bank south of me that's now in cryptocurrency. It's driving huge fee income. But what does your strategic plan tell you you're doing as it relates to risk? Again, are you into mergers and acquisitions? Are you acquiring businesses to grow the bank? All those factors, how much do you want to grow? How much do you want to earn? Drive your risk appetite development. And obviously reputation is an outcome of that. If you're really conservative and you have a modest level of growth, you have the same customers you've had for 20 years, you're not really changing your model, you're in a kind of a rural, nice little bedroom community that's all's going well, you might have pretty low risk appetite across the board and very minimal reputation risk. But if you're doing some of the things I just described, you have some added reputational risk. Be candid with yourself and say, you know what, by doing some of these things, maybe I'm taking on a little additional reputation risk because, I have to consider my shareholders, my customers, my employees, my partners, and by all means, my regulators are all stakeholders, and they're all subject to my reputation. So once you've gone through all those considerations, you need to plot it, right? So you said, let's look at credit, let's look at any one of our categories, and you drop it into the heat map based on some logical assumptions around your business model, right? And again, we're kind of using this framework. If you're using CAMELS, use CAMELS. You're going to use kind of a 5-point scale typically. That's kind of an industry standard out there. But once you've asked yourself all those considerations, I think this is still kind of an art and a science. We have an assessment that establishes a baseline for things like risk appetite. It asks a bunch of good questions about risk appetite, but in the end, you end up modifying it based on other factors. But the third step in step 2 is populate the heat map, right? Select your areas based on answering a series of questions related to how much risk you're taking. That moves you to, how do you go about defining what each of these risk ratings mean? So if I say my risk appetite is moderate, the risk appetite statements exist to help people understand what you mean when you say that. Right? So in this case, let's just use some examples we have here. There should be 2 things that go into every risk appetite statement. One, if you say what your risk appetite is X, by all means, tell them what that means. If my risk appetite in a certain area is moderate or moderate high, based on what? Articulate it. And then the one I always think makes sense in a risk appetite statement too is define at least a summary of your controls around that risk category. So for example, if we look at this one that says credit risk on the screen, well, my credit risk is moderate high. My risk appetite is moderate high. Well, what's my statement lead with? My credit risk appetite is moderate high. We recognize that our concentration in CRE and SBA, our growth rate, our rate of entry into new markets are primary contributing factors that result in a moderate high rating. And then to control this level of risk, boom, we talk about our control systems, our underwriting processes, our investment in technology, are relying on high quality independent third-party reviews, our stress testing. So define what the risk means and then how you control it. Operational risk, this one says moderate, moderate, high. Our operational risk appetite is moderate to moderate high when considering our desire to adopt technology solutions that enhance our client experience and improve efficiencies. We're also exposed to an increased level of risk associated with ACH and wire volume and size, and growing dependency on third-party providers. I mean, these are general examples. Look at your business model, look at the risk you're willing to take, and define what you mean by that level of risk you're taking, and then say something about your controls. I think those make for good quality statements, and it brings both a quantitative and qualitative element. And I really look at the KRIs, or the key risk indicators, to be the quantitative measurement. The risk appetite statement is more of the description. Right? It's describing it. So let's look at that fourth consideration. So now that you've established your bank's risk appetite, the framework, and you've done your statements, the last step in this 4-step process is to develop metrics that allow you to monitor performance levels versus your risk appetite, right? And the metrics, some people call them, key performance indicators, right? Supposed to be internal. Key risk indicators, external, or you can just call everything key risk indicators. It doesn't really matter. The point I want to make is when you select key risk indicators, try to be selective, right? Try to keep it to the vital few. And then the goal in establishing KRIs, or your key risk indicators, key performance indicators, call them what you will, is to identify what they are and then develop the range of what low to high looks like. So, I'd probably beat up on credit, but it's such an easy one to look at. So let's say CRE is one of your KRIs. You're looking at your CRE concentrations. Low could be less than 200, and then you just go up from there, and high might be greater than 300 or 350 or 400, and you plot it in between there. Non-performing assets could be held at a certain level of low to high. Policy exceptions could be run low to high. If you're thinking about interest rate risk, you can use your ALCO package to help you determine your levels and ranges. Liquidity risk, we kind of mentioned them earlier. You might have a liquidity ratio. What's low and high look like? What's your loan to deposit ratio look like, low to high? What does your dependency on non-core funding look like? What's your use of broker deposits? What are your pledged securities? But plot those low to high and track where you're at. When you think of operational risk, it could be a ton of things. It could be quantitative expense looking items. It could be number of transaction activities on your debit card. It could be fraud incidents. We break cyber risk out now, but in the old days, operational risk, you might have IT exams. But it's a combination of things that you can measure, right? And so think about those key risk categories that you've established and coming up with, 3, 4, or 5 key risk indicators that you can quantify, right? And then you can set up a system to track it and monitor it. You've kind of set up a quasi-dashboard. And if they're public data points, you can even put comparative analysis over them. Okay. So how does this all kind of come together? So, once you've established your risk appetite, it really does, first of all, I just want to point out, it does really provide a great basis to launch into a really effective enterprise risk management process, right? Because you've basically articulated where your risk resides. But as far as bringing it all together, and there's just some images on your screen, but this is a point where you're saying, now how do I bundle this all together to communicate it effectively? So obviously your heat map, you can drop into it and drop that into a document. You can summarize all of your risk appetite statements, and then find some sort of visual, be it charts and graphs or a table. But these need to be bundled, right? Because if you really think about it, at some point in time, you want to communicate this out, right? You want to do it in an articulate fashion, and it could be to your board. It will be to your board. Could be to regulators. It could be to your employees, so they kind of understand. Understanding what we're willing to do and not to do to make money is kind of a nice thing to share with employees. And, you may even share it with investors, but you may have different audiences. So as far as bringing it all together, it's bringing these pieces together. And then I encourage setting up a quarterly reporting system so you can keep an eye on how you're moving within these risk ranges that you've established for yourself. And again, the driving force behind understanding a risk appetite forces this disciplined discussion about where risk resides and what you're willing to do and not to do to make money. It's a relevant discussion today. It's one that should be had between management and the board on a regular basis, which kind of leads me to my closing thought. I want to talk a little bit about the difference between risk appetite and risk profile. They both exist. They both have a purpose. But I don't want you to confuse the two. Your risk appetite is more or less a desired state. It's nothing more than a reflection of where you desire your risk to be in pursuit of value, right? It's kind of like saying, hey, this is our strategy. We'll take this much risk here, and we don't want to take more risk there. We don't, maybe we'll take less, but it's a desired state. Your risk profile is your actual state. It says, hey, based on analysis, our inherent risk is X. Our adequacy of risk management is Y. Our composite or residual risk is Z, and the direction is this, right? That's a risk profile. But sometimes people look at these two and they kind of think they're one and the same. They're really not. Risk appetite is your intent. Your risk profile is the actual condition. Now, I will point something out. If you find, and the reason I like putting these side by side, if you find that, let's say operational risk, you're doing a lot of M&A stuff, you're investing a lot in technology, you're doing a bunch of third-party agreements and partnering with fintech to do a bunch of stuff. So let's just say your operational risk appetite is high. And then if you come over to the risk profile side, even at the roll-up, and my guess is your operational risk, inherent risk would probably be high. But if your adequacy of risk management is, say, acceptable or below, how long do you want your adequacy of risk management to just be acceptable in an area that you say you have high risk appetite? You want to make sure that your controls and the adequacy of your management is strong, acceptable to strong in any area that you have moderate, high, or high risk appetite. Because if you don't have that level of management strength and controls in place, you have no business having that level of risk appetite in those areas. So that's the relationship between understanding your risk appetite and your risk profile. Okay? So I probably run a little long. I hope that provided you with some interesting insights. I do want to say, just take a minute to talk about us before we go to Q&A. We recognize that each bank may be a little different as far as, implementing an ERM process. We have designed our solutions in a manner that each of our clients can consume the whole elephant or take a bite at a time. But the one thing that's consistent in what we do, it's the quality of good intelligence that we bring to the process, some automated solutions, some analytics, and industry insights that really helps our clients ensure that their risk management priorities and their business performance priorities are synchronized. And it's very important to understand when you're looking at risk and looking at performance that they're not mutually exclusive and they should be synchronized. And that's what we do with our customers. So with that, I'll just ask if there's any questions. I think I see one. Let me see if I can scroll to it. Oh, here we go. Oh, okay. It's just a message to send the slides. That's great. Will do. So any questions on any point of risk appetite process? I hope you found the four-step process somewhat insightful. I know there's some heavy lifting in there, but it's time well spent. It's something that I think in today's competitive landscape with the movement and or if you're considering getting into the cannabis banking business, understanding where your risk resides and how you control that risk is really essential to compete effectively and optimize your performance today. So again, I hope you found our time together useful. I hope that if you want to learn more about how we can help you with your risk appetite or any other services, that you'll give us your full consideration. Thank you again for taking time out of your busy schedule, and we hope we connect with you real soon. And bear in mind, if you do want a copy of this, by all means, shoot us an email, give us a call, or just let us know vis-a-vis go to webinar. Thank you so much.